Good morning and welcome to our live webinar, Value Series on Tax Planning, Tax Considerations for Investing and Doing Business in the United States, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface, and you should see something that looks like this on your own computer desktop in the upper right corner. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 1.25 CPE credits in taxes, and you will need to respond to 4 of the polling questions to receive credit. If you are having difficulty responding to a question, it is recommended you come out of full screen mode to respond. CPE certificates will be issued within 8 to 10 days via email. A recording of today's webinar and a copy of the PowerPoint slides will be made available to you via email a few hours after the event. And at the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. In today's webinar, our speakers have plenty of material they will cover. After going through a set of introductions, they will kick off the presentation with an overview of the United States tax system, after which we'll lead into the topic of operating U.S. trade or business without or with subsidiary. Then our speakers will address a few issues surrounding corporate income tax, sales, and use of tax nexus. And then finally, they will cover the basics of transfer pricing. Before closing out the webinar, we will have a Q&A session. And at this time, I would like to introduce Leo Parmegiani, partner and head of the international tax practice with PKF O'Connor Davies. Leo?
Well, thank you for that introduction, Harleen. Well, good morning, good afternoon, and good morning, good afternoon, and good evening, everyone, depending upon where you are. And thank you for joining us for our presentation of tax considerations for investing and doing business in the United States. We welcome you, and we're pleased you are able to attend. My name is Leo Parmegiani. I head up the International Tax Services team at PKF O'Connor Davies, and I'm joined by my colleagues, tax partners Belyavskaya and Ralf Ruedenburg. The topic we are covering is an area which we deal with on a day-to-day basis in our practice. We advise companies when they physically enter the U.S. market or simply get caught up in the U.S. tax net. The goal of the presentation is to provide a survey of tax issues which need to be considered when U.S. companies are entering the U.S. market, whether by direct sales to consumers, through third-party logistic providers like Amazon, or by physical presence of employees, inventory, or other tangible assets in the U.S., and more these days, intangibles. Typical key questions we ask our clients in these scenarios are, what is your product? What is the current and planned volume of your sales activity in the U.S.? Where will you be located, and do your employees or other agents travel to such locations? Do you have physical assets in the U.S. such as inventory, computer servers, or other office equipment? Have you formed any U.S. entities or registered to do business in a state? And most importantly, have you received any advice from an international tax advisor, like a CPA or attorney in the past? In prior years, the initial focus of our analysis was federal taxes. But now, with new game-changing state tax laws, tax implications begin at the state level, in many cases, even before physical presence exists in the U.S. In our experience, we've noted that non-U.S. businesses entering the U.S. market believe they're entering one country, but in fact, they're entering at least 52 countries, counting the 50 states and the District of Columbia, not to mention the countless city and local counties which may be assessing tax. It is our role as tax advisors to lead them down a proper path, because a mistake at the onset could cause business-threatening tax, interest, and penalties, which have to be considered for the future. With this in mind, we invite you to listen closely as we provide a survey of issues to be considered when you make your first sale to a U.S. customer. Our first speaker is Belyavskaya. Eve, please take it away.
Thank you, Leo, for the kind introduction. And welcome, everybody. Thank you for joining us today. I'm Belyavskaya. I'm International Tax Partner at PKF O'Connor Davis in New York City office. And I will try to provide a summary or an overview of a US tax system for you, so that hopefully after this presentation, you take in all the insights into the complexities of doing business in the United States, whether you're going to have a share of the US business or you're just going to start a new company. So we're moving to the different types of taxes, right? We tried to put together a table on the next slide for you that would kind of summarize all sorts of taxes that are our bread and butter. And the levels of taxes in the United States start with the federal. You can see, as Leo has mentioned, the state taxes are far more complex than it can seem at a first glance. They're a little bit more than just on the federal and the local taxes. The most important tax is unexpected tax. And this is something that you want to advise your clients about. So if you look at the slide, you'll see that there are 3 levels, right? We start with the federal taxes. The federal taxes are usually your, regular income tax, corporate and individual tax. When you're trying to move people into the United States, you have to be privy of payroll tax. Payroll tax and sales tax in the United States are personal liabilities. So it's important to be compliant, otherwise it may lead to some controversies down the road, and you may need some legal assistance. State taxes are far more complex than federal taxes. It's like dealing with 50 different countries, as Leo mentioned. It's an income tax. It could be a franchise tax, unemployment tax, sales and use, which is very important, especially if you're selling goods or services into the United States and directly to the end user. Property tax is important, real estate transfer tax as well. They're local taxes for fortunate people like me who live and work in Manhattan, and we are subject to local and municipal taxes, such as New York City, for example. A few localities throughout the United States have local taxes, such as Philadelphia. So this is sort of an overview of what you can expect when you're coming to the United States or starting a new business venture. We are moving to our first polling question of the session, and it is quite simple: whether you want to get CPE for attending this presentation. Okay, I think we can move on. All right, so over the next couple of slides, we go through them briefly because this is just a sort of a summary and a table for you to understand how many different jurisdictions we have to deal with when we advise our clients or you how to do business in the United States and what exposures you may have on a state or local level. The highest corporate tax rate in the state right now is in the state of New Jersey, followed by states like Illinois and Minnesota, California, New York, etc. We can also mention some of the states that don't have corporate tax, and we typically advise clients who are especially trying to expand into the US market and don't have anticipated plans in the nearest future, but do want to start establishing its presence, to go with the states that have no income tax. That allows for some flexibility when you try to move between the states, or you're trying to sell to different states, or moving people within different states. So moving on to the next slide, just to give you an idea of the tax rate that is going to be added to your federal income tax. If you're an individual, if you're an executive or a high net worth individual who's coming to the United States, inadvertently you may create a resident tax status, and once you do, you may be pulled into the state as well. The highest individual tax rate right now is in California, followed by wonderful Hawaii and our state of New York. The next slide will tell you the sales tax rates in the United States that are quite high. And the two states in 22 that are leading are Louisiana and Tennessee. Very important, if you sell services or goods into those states and you're sourcing it, and my colleague later in the presentation will tell you more about the sourcing rules, depending on where you source your sales, whether you're a foreign corporation or US corporation, the rules of the sales tax or income tax on the state level apply to both foreign companies and US companies at the same way. So Louisiana and Tennessee are the two highest states with its sales tax rates in 22. We will now move to our polling question number 2.
Okay, I guess that's mine, Eve. Which state has the highest corporate income tax rate in the US? Your choices are New York, California, and Hawaii. Please select one. We should have added New York City and New York combined.
Tell me about it. All right. Okay. I think we can move on. All right. So in order for us to provide a better insight into doing business in the United States, there are a couple of ways how you can do it. You can do it with the US subsidiary, or you can use a foreign company and operate in the United States without a US company. There are options. Before you consider doing business in the United States, in the next slide, we're just summarizing a couple of things that you need to think about before you come and consider starting a business, right? So for example, if you think about who you are, right? Are you an investor by nature? Are you going to just, be a silent partner in some US business venture? Or you'd like to have an ownership in the startup? Would you like to own an interest in the US corporation, or would you like to start a new company? You have all those options. You can also continue using a foreign company if you have one to operate in the United States. And we will discuss later on what pitfalls to look out for. You can think about also, if you have an executive that you're going to bring to the United States, what is going to be their role or their position in the newly created US entity should you decide to use a new entity in the United States. You can also think about a foreign entity sending an executive to do business in the United States, and what responsibilities that person is going to have. Because sometimes inadvertently, by signing one contract, it may expose a foreign company to have something that what we call permanent establishment in the United States, and we'll talk about it later. Most important thing that we want you to be aware of is you have to know and you have to have necessary resources, and also know the professionals with proper qualifications to start a business in the United States. We're moving to the next slide, right, where we talk about a little bit, just a summary of what you need to think about. You should think about an attorney, right, when you're coming to the United States. Fortunately, in the United States, unlike many other countries in the world, US public accounting companies are not licensed to provide legal services, so be aware of that. Nevertheless, we employ lawyers at our company, and we have a very strong network of lawyers, be it immigration, litigation, tax, corporate lawyer, labor tax lawyer. We have a very strong network of lawyers that we work with. So it's important when we work with them to understand the needs of the clients, to see which portion of the goal that we are assisting with. Accounting support is one of the things that we talk about all the time. Usually, companies who come to the United States like to stick to the softwares that they're using. Sometimes it may create differences with US GAAP. We can always assist with that. Any type of attest services, depending on the size of the company that's coming to the United States, we can provide all types of attest services as well. In our PKF family, we have one accounting software that we're streamlining that right now facilitates the easy transition from one PKF office to another, so it works quite well. Tax compliance support. I have mentioned the state income and sales taxes. On the income tax, this is where we come in, and this is what we do. We assist you with income tax, withholding taxes, any other issues. Any advisory related to sales tax, obviously we have a strong group that can help you with that as well. Tax compliance support, the foreign filings. US, as you may know, is notoriously strict about disclosing any information related to any foreign entities, such as FATCA, controlled foreign corporations. You may have heard terms like GILTI, Subpart F income, etc. They're quite complex. I mean, they can be very easy to resolve if the company is small. However, when we deal with multinational corporations that have a lot of subsidiaries within a group, it is very important to know exactly what you're doing because the penalties could be quite strict. It can start with $10,000, it can go up to $25,000 for a failure to file one form only, so be aware of that. Payroll support. This is something that we advise on. The niche of payroll in the United States is occupied by very good professionals and companies that we work with. So we help you to streamline it. Important thing to do before you move people into the United States or before you hire people in the United States, it's very important to talk to either us or payroll contacts that we can provide for you to make sure that you have all proper registrations with the state. God forbid you don't have workers' compensation insurance when you have more than 2 employees in the state of New York. That is a red flag for a workers' compensation audit. Now, these are the things that you have to be aware of. We'll talk about limited liability and unlimited liability down the road in the presentation, but what I do want to point out that things like sales tax and payroll tax, these are the things that will end up as a personal liability. So if you're not tax compliant throughout your business activity, you may have some tax controversies down the road. So be aware of that. That's very important. Banking, one last thing to mention here. Banking, 15 years ago, it was quite easy for a US person to come and open a bank account for a foreign corporation in the United States. It has not been easy for the past couple of years. However, we personally don't do any banking and don't assist you with banking, but we do have a strong network of banks who would talk to you and see what your needs are. Instead of using the online banks that a lot of companies are using now, because they can just open US bank just by walking in there without a physical presence, or without a person with a social security number. There are ways for foreign companies or US companies of foreign parents to open banks in the United States, so we can help you with that. We're moving to the next slide, and here we'll talk a little bit more about what does it mean, how can you do business in the United States. We've talked about that you can have a subsidiary or you can still operate by using your foreign entity. Before going into this, I do want to mention that a major part of our advisory and analysis is based on US income tax treaties with numerous countries all over the world. And recently, over the past 12 months, there have been numerous updates in that world. There has been a US-Chile treaty that has been adopted finally. There's some negotiation that has been confirmed and now awaiting resolution for Poland and Romania. There was a termination of a treaty with Hungary. There are discussions of a treaty with Israel and Taiwan. So there are a lot of things that are happening right now due to current geopolitical events. But nevertheless, this is one of the things that is very important when you have foreign operations or you have foreign clients to us that we advise on, because you want to end up, avoid double taxation in the end. So operating without a subsidiary, right? That can be anything. You may have a virtual office in the United States without setting your foot into the United States. You may have a e-commerce business. You can use a service that could be located in the United States and outside of the United States. One point here, that when you talk about the servers, you have to make sure which state they're in. So if you do have this scenario, do your research. Do your research about the state of Virginia, for example, right? Or some other state that would allow for less of a tax burden. Coming to the United States as an employee. If you're a foreign entity and you're moving employees in here, that will essentially be doing business in the United States using your foreign entity. So it's important to know what is it that you need to do. That usually depends on the period and the time of the proposed residence of that employee or assignment of that employee in the United States. So talk to us if you have any questions about that. One of the recommended options, especially if you have long-term plans in the United States, is to open a US company. We will talk about different types of US companies, but one of them, it can be essentially anything. You can acquire an interest in the US entity, you can just start a new entity, or you can combine your efforts with someone else and create a business venture. A few examples on the next slide of what I have just mentioned. There, you can essentially have a foreign company which would import goods into the United States with no US legal entity. You can have a US subsidiary that is going to be 100% owned or co-owned by a foreign parent. For example, you can have a company in UK who is going to expand in the US. Both of them are corporations. That would be your structure. Of course, you would need to consider transfer pricing considerations here, etc. U.S. holding corporation can have various controlled foreign companies operating outside of the United States. That is also one of the structures that you can have. What they want, or you can have both, right? You can have a U.S. company that is owned by a foreign parent and the one that owns the foreign subsidiaries. This is something that we refer in the United States as a U.S. sandwich structure, which we typically try to avoid. Because once you start to repatriate the earnings from the bottom companies, from foreign subsidiaries into the United States, and then from the United States back to your foreign parent, that would lead to a lot of tax inefficiencies because of the numerous layers of taxes that would be applied, withholding and income taxes that would be applied to the US entity. We're moving to a next slide. Where we talk, what does it mean to operate business in the United States without a subsidiary? Well, one of the things that I've mentioned in the beginning was a term permanent establishment. When you're using your foreign company and you come to the United States, it's important to know what activities this foreign company is going to have in the United States. For example, as I mentioned, you can send people. And if that person has an authority, maybe it's an executive or a director, and that person may have an authority to sign contracts, you may inadvertently create permanent establishment. What does it mean to you on the tax sense? That would mean that if a company has permanent establishment, a foreign company will need to file a US corporation tax return and reported earnings related to that US activity, as well as the deduction related to it. So it may end up paying tax in the United States. So be careful and talk to us if you have any hesitation. Another thing that it also is very important, as we mentioned, is that you cannot just operate in the United States on a federal level. You are always pulled in some type of a state. So if you are selling to the United States and your customer is located in the United States, most likely this customer has a state, so they are in some state. What we mean by nexus is pretty much a connection. You're establishing a connection in the state. You can accidentally establish a connection in the United States even without being physically in that state. One of the things they do established nexus on the state level would be an employee. It could be a physical office. It could be a warehouse, or it could be just the amount of sales that you have into that state, as well as the number of transactions. To speak a little bit about permanent establishment in more details on the next slide, what is a permanent establishment and how do you create it, right? Essentially, it's quite easy. The permanent establishment, according to the US Model Income Tax Convention, is any place of business. It could be a place of management, could be an office, could be an employee renting an office, it could be a workshop, any type of business activity that may be present in the United States that could create permanent establishment and will require to file a US tax return and pay tax. One thing to mention here on a federal level that you want to take into consideration, if you are selling consumer goods or tangible goods in the United States and you're having a storage in the United States, on a federal level, that will not bring you to having a permanent establishment. Now, on the state level, that would be a different issue. So you will have situations sometimes when a foreign company does not pay any federal tax, but will pay some type of income tax or franchise tax on the state level. One thing to mention that some states follow tax treaties and some states don't. Unfortunately, it is what it is. And until everyone agrees on some type of unitary approach, it will be that way, where we would need to check every state whether it has it agrees with the federal tax treatment. So we talk about federal tax compliance further on and the requirements and what are the other options, right? On the next slide. One thing that you would need to do is to file your federal tax return. If you're operating without, as I mentioned, without a US subsidiary, the IRS can tax gross income if the tax return was not submitted 18 months after due date to file such return. So be aware of that. There is additional tax, branch profits tax, and if you have any issues, just reach out to us. We'll tell you and explain to you what it means. Protective tax return. What we mean by protective tax return. Sometimes when the foreign company is doing something in the United States, it may not be fully covered by the US income tax treaty with that country. So it should be, there could be some uncertainty, or it could be an article that prevents US considering that company having a permanent establishment in the United States. We typically, in this situations, advise foreign companies to file what we call a protective tax return. Protective tax returns gives you the right, should you ever question or should you have any issues with reporting your income tax or requirements to report your revenue in the United States, filing a protective tax return may protect the right to claim the deduction against that revenue. So essentially, you may be saving some money in the future if you do so. It also will help you avoid potential penalties. If you don't file anything just because you think there is a treaty between, it is better to report it, show the treaty that you're claiming, and then have that in your files should the IRS question you later on. We're moving to a polling question number 3. Does a warehouse in the United States create nexus in a state? Okay.
I think we
All
can
right.
safely say the answer is what, Eve, in that case?
It is yes. I just had to read the question again because I was thinking of a federal level.
Good answer. Federal level maybe also, depending on the treaty.
Depending on the treaty, exactly. All right. So we're moving on to talking about operating a U.S. trade or business with a subsidiary. And what does that mean? The first thing to take into account before you start any subsidiary or you open a U.S. company is what type of legal entity you're trying to have. But most importantly, what are your long-term goals and how, if you know the answer, you would like to be taxed or not. So the first thing to remember is the liability. There are entities that have limited liabilities and then and the other entities that don't. So it's important to think about the tax burden. Financing. How are you going to bring investment into the United States? During the first year of operation, that may not be that important because, you know, you can just give some advancement to a U.S. company and it uses this money to start its business and start generating sales from the United States. However, once we file the tax return, we need to come to a conclusion or agree on what is that advancement is. You can provide a loan to your company, which is also a consideration for transfer pricing. You can invest into the United States, right? But when you do so as an equity, but when you do so, you have to think about how you're going to take the money out. What is your succession plan? Or do you have one? Are you just trying to grow the company? Don't worry about it at the moment. Or you're really thinking about this is your business venture and this is the way I'm going to be out. Taking any return back on your investment can have some withholdings on the US side. So we have to talk to you about that if you know what you're doing. Compliance cost. Various tax structures and usually inefficient advice in the beginning may lead you to have higher compliance costs than other people. I've talked about the US sandwich structure. If you have that and you have numerous foreign controlled corporations that are owned by a US person, and by US person I mean a corporation or an individual, that may increase your compliance costs significantly. There is a specific form that needs to be filed, and if the company is profitable, there is a different type of tax that we would need to look at to carve out that portion and include that portion into your US tax filing. So be aware of that. If you have any proposed restructuring, or there's someone is purchasing, or there's any M&A transactions in the future that you're thinking about, reach out to us. We will help you with that. I've talked a little bit about the intentions of the investors. One thing to mention here, which was quite new last year, and it's going into this year, usually when you used to do business in the United States, you would create a corporation, or let's say any other type of entity on the state level, and not always you need to provide the owner information on there. Sometimes it could be just an entity that would have a registered agent in the United States. You will pick a state with no income or corporate tax, like, for example, Delaware or Nevada, and you do business in the United States, and it doesn't where you don't get to the level of tax on the state level because you don't have any nexus in those states. So it's easy. It was easy to do business like that. Right now, there are proposed regulations and new rules that would require every beneficial owner to disclose this information in the United States. Now, we understand that this has been happening all over the world, and it's quite common to have that in Europe. You know who the owners are, and other parts of the world. In the United States, it was not public information. But now we're going into a world where it will be. On the next slide, we'll talk about options for your legal structure. There could be different structures. As I've mentioned, there could be one with no limited liability and the one with limited liability. The most suggested entity type in the United States for any activity to serve as a blocker would be a corporation. corporation. However, depending on the income tax rates with other countries and income tax treaties with other countries, we have to always look on the other side, where the investor is coming from, where the company is coming from, what country is this, who owns that company in that other company, because there may be several countries involved in the quite complex org structures. So in the United States, you have a corporation which protects the liability and also serves as a blocker for tax purposes. You have an entity that is registered at the state level, and it's called limited liability company, which is, we refer to it as an LLC. If you talk to a lawyer in the beginning of your discussions of doing business in the United States, you may be advised to open an LLC. Just be aware that an LLC itself, if it's owned by one person, will be disregarded for tax purposes in the United States on the federal level. So you will end up picking up the revenue, if this LLC, picking up the revenue and deductions as the owner, and will need to file US tax return, especially if you're a foreign person or company. Moving on to legal entities, which I have just mentioned. I've just talked about the LLC. You can start on a state level with any type of entity, essentially. You can start with a limited liability company. You register everything in the United States on the state level first. The IRS does not provide you with a registration for a new company unless you receive a tax identification number, which is your tax ID. Eventually, you will need that, but first you go to the state and you first think what state you're going to have the majority of your activity in the beginning. Now, if you're a company that sells services, or let's say you're a payment providing company, you may need to receive certain licenses all over the states. So you may end up having to file 50 states just because you had to register to do business in the state in order to, for example, receive monetary transmitter license if you're an electronic payment provider. So be aware of situations where, or if you are pulled into the states, and talk to us if you have any questions about that. As I said, you start with an LLC. If you have a brand name, fashion brand, or you are an artist, or you're concerned about branding a company that's going to produce tangible or services, produce tangible goods and sell them to the United States, or sell specific services, and you want to be recognized by the brand, the lawyer will advise you to create an LLC. That just protects that on that side. However, in order for that LLC to be tax efficient for you, we will typically recommend making this transparent entity into a blocker entity by something that we call check the box. Essentially, you can do a reversal. You can make an entity that is a foreign entity, for example, a flow through, or you can make it a blocking entity in the United States. There are various solutions to many problems that you may face. So talk to us about that. Just very briefly on the next slide, I wanted to show you one thing about how you can file tax returns in the United States, where you, for example, will have, well, it's not on this slide, but I'll talk about it. You will have 3 entities in the United States, right? You may have 3 different revenue streams or 3 different projects. You don't want to commingle them. You have them separately. There is an option in the United States, if you want to make a U.S. company a holdco, to consolidate the tax filings of this group in the United States. Why is it good? Well, one entity can be profitable, another entity can be not producing any income yet. It will have losses. So while doing that, you can consolidate, and that way ease your tax burden, as well as accumulating net operating losses. If one company historically has been loss producing, you can utilize those losses up to a certain extent and up to a certain percentage. We can help you to figure this out. You can utilize these losses down the road during the years when all of these entities are profitable, so be aware of that. Now, on the federal level, it is an option. On some state levels, it can be a requirement. So the states typically would provide, as we said, 50 different tax codes, 50 different mindsets. You may be required to file a standalone return for the entity in one state, and unitary, consolidated, or combined return in another state. And to finish and summarize this presentation, just wanted to give you one example of the tax burden consideration on the next slide, and that has been done from a perspective of one country. You can see it says foreign company owner, and then that owner owns a foreign company corporation or partnership, which could be a different treatment for tax purposes, and that entity would own the LLC. So I won't go into the details of that, but you can see that one structure on the far right of 25%, that is tell you what would be a total effective rate to the ultimate beneficial owner if you create a proper structure. The one on the left, it can range from 25%, but the one on the left is 63%. So be very careful about what entity you create. All right, so one of the last things I wanted to share is the tax compliance. And one of the things on the state level is obviously following the federal tax return, you will need to file a income tax return on a state level as well as a franchise tax. There are some states that will not have a corporate income tax, like Texas, for example, but they may have a significant franchise tax exposure if you have connection to the state. Delaware is the go-to state for any activity when you're starting your business. It may lead, it's usually pretty low cost to maintain a Delaware company, but if you inject a lot of cash into the entity, it may lead you to significant franchise tax filings on an annual basis to Delaware. I've mentioned that the states typically do not follow US tax treaty, but there are states that do, which eases our work quite significantly. So with this, I will end my presentation and I will turn to Ralf Ruedenburg, my colleague, who will talk more about corporate income tax and sales and use tax nexus issues.
Thank you, Eve. So hello, everybody. From my side, I'm Ralf Ruedenburg, partner in the international tax group at PKF O'Connor Davies in New York City with 20 plus years experience in the international tax and audit world. And thank you, Eve, for this excellent introduction overview. US tax, permanent establishment nexus. We will talk in much more detail now about issues that surround corporate income tax and sales and use tax nexus in the US, followed by brief overview introduction with regards to transfer pricing. But I think before I do that, next one is a polling question, just maybe to test knowledge here. It doesn't really matter what you answer if you don't know it. So are services protected by Public Law 86-272? I will go into details, but just give it a shot. And of course, I will give you the solution after this one. Okay, so the answer to that question is a no, and you will hear in a few minutes why that is the case. So we can move to the next slide where we'll just emphasize what Eve said before, because what we will talk about mainly in the next 20 minutes or so will be the nexus, which is the term that is used on a state level in the US, versus permanent establishment. I'm not repeating the whole thing again, but it's just really important at this point to understand permanent establishment is a term that is used on the federal level. It's a tax treaty term mainly to find out if a person, entity has a permanent establishment in the US and has to file tax returns, has to register. That's not me. There's no background noise. Yeah, here's some background noise, but it's not me. So versus the nexus term, which is much broader than permanent establishment. I think as a rule of thumb, you can say everything that's permanent establishment is also nexus, but everything that's nexus is not permanent establishment. So I can take it that way. And on the next slide, we will see what standards are being used by all states, by all 50 states in the US to determine whether corporate state income nexus has been established. Right? So there are different rules for income tax and sales tax. I will cover income tax first. So there are essentially 4 categories: factor presence in state gross receipts, authorized to do business, economic presence, physical presence. So physical presence more or less speaks for itself. Yves mentioned that before. If you have an office, if you have a warehouse, if you have an employee in the state, doesn't matter if they work from home, if they work in an office any longer. During COVID was different, but now it doesn't really matter anymore. So physical presence speaks for itself. Economic presence, factor presence in state gross receipts, very similar categories. They look at revenue generated in a state. So if certain thresholds are exceeded, the state would say, you have business, trade or business activities in our state that really exceed potential de minimis number we have. Some states have it, some states not. So you have created nexus in our state. We expect you to register. We expect you to source a sales to our state, submit tax returns, pay tax. States have different thresholds, maybe just a few examples. California, one of the more prominent states, around $650,000 is the threshold. It's adjusted every year for inflation. New York has 1 million threshold. A number of states don't have a threshold. They just say, it's very broad, they just say, if you generate income in our state, we consider that as being nexus in our state. Authorized to do business, that plays a role in income tax, sales tax. If you have customers in the state, sell to customers. Sometimes you need a vendor's license to be able to sell to customers in that state. You may need an authorization to do business in that state. And then the question is, let's say you do it for sales tax. Does it automatically mean you have to submit an income tax return? Does it already create income tax nexus? And the question needs to be answered state by state. But in general, you can say, if you are registered in a state, authorized to do business in a state, the state would expect you to show up to submit a tax return. So that's the general answer, but there are exceptions to that answer. When we look at the bottom of the slide, you see, be aware of Public Law 86/270.
Ralph, I think you went ahead and muted yourself.
When did that happen? I was unmuted, right?
Just continue. You were talking about the standards.
Yeah, okay, good. So I don't know when I did that. Okay, so Public Law 86/272, federal law that prohibits states to tax businesses when they don't have a physical presence in the state generally, and the only activity in the state is solicitation. So you just have someone, independent contractor or salesperson in the state presenting products to potential customers, taking orders, but the orders are not allowed to be processed in the state. They have to be processed outside the state. So if these activities are really mere solicitation, the state would not be allowed, even if you generate revenue in the state, to tax you. So that law was used for income tax and sales tax. For sales tax, it's gone. I will talk about that on the next slide, but the very important thing here to keep in mind is that this public law does not protect the sale of services. right? It only protects the sale of tangible assets and not services and not intangible assets if you're selling intangible assets. So I leave it at that for the income nexus. Next slide will show us the standards to determine whether sales and use tax nexus has been established for sales tax purposes or not. And you see that there's a lot more categories here. You see some which we saw on the previous slide, like economic nexus, but there's a lot of other factors that can play a role here. And then fifth from the bottom, you see warehouse and state. That's what Yves said, right? Just to re-emphasize, warehouse on a federal level, most cases, not a permanent establishment, nexus on a state level. And I can say it's in all states. There's no exception. And just from a practical side, what we see is that states, especially since 2018, when we had this Wayfair decision, which I mentioned on the bottom here, we have states that they do audits in warehouses to see who are the customers of these warehouses, right? And especially if these customers are foreign, so outside non-US, which is quite often the case because players like Amazon, they request vendors to have products in the US to fulfill the promise of one-day delivery, right? So we have a lot of cases where we have foreign vendors that have products in the US and are not aware that they have a nexus in a state and they should show up and do something about it, at least do an analysis. And Yves mentioned that before. There might be a tax treaty that help in this case as well, although it has to be said that tax treaties do not apply to sales tax. So it's a analysis state by state. Next slide. So I will leave it at that with nexus for income tax and sales tax. I prepared a few examples just to make this a little bit more vivid. So first example is, so either foreign or domestic entity has employees working in a state for 10 days during one calendar year. And the entity, the foreign entity, does not have any physical presence in the state or in the US at all. So example could be foreign entity would like to explore US market and is sending people to trade fairs, for example, or they made contact with potential customers, want to visit the customer and visit the United States, do a 2-week business trip, visiting different locations in one state or different states. So what is that going to do? Is there something you have to consider? And the answer is yes, you have, because there are states that are really quite aggressive. And for this specific example, I would like to mention the state of Florida. So Florida has a limit of being present in the state of 10 man days, man, women, them days in the state. So if you have, let's say, one person who is present 10 days in Florida, the theory, if you go by the book, it means you have created nexus in Florida and you would have to register with all consequences. And that's a theory, right? Again. And these 10 days would also mean if you have 2 people going 5 days, it's also 10 days, right? So it's a total number of days that counts here. So going to the next example, please. So we have a foreign entity that's providing cloud computing services remotely and is using servers located in the state. And no physical presence such as an office or warehouse does exist. So that's in these days, we really have a lot of clients who are operating like this, that they developed an app, they find customers online, like a lot of businesses in these days, and they start providing cloud computing services, mainly software as a service. I mean, there are other services, platform as a service, infrastructure as a service, but we see mainly software as a service. They have customers in the US who are using these services. And so what does that mean for the foreign business, right? Because what we mostly see is that our clients, they record the revenue outside of the United States, tax it outside of the United States and be done with it. Unfortunately, it's not that easy, and the rules are really changing, not every day, but quite frequently, because states realize what's happening there. I mean, we have this cloud computing services going on for a while now, of course, but the tax authorities are a little bit slower on that. But more and more states realize, oh, there's an opportunity for us to bring in businesses into our state and tax them on what they generate as revenue. So it is possible, especially in this example, when a company is using servers that are located in a state, which is tangible property, that the state might say, okay, you're using a server in our state, might not be yours, you're renting it, but even renting tangible property in a state might create nexus. You have created nexus, right? You have created nexus, you have to register, you have to source the revenue here, you have to carve it out from your foreign books, and we would like to see tax here. And that services, there's no protection, right? As I mentioned earlier, this public law does not protect services, so it would not protect a business in this case. So this analysis is a very detailed analysis which we would have to do, because a lot of companies, maybe just a few sentences more here, use, for example, web service providers like Microsoft, Amazon. Right? They have huge networks of servers that they offer to clients and to their customers. And I had cases where we said, okay, so where's Amazon routing your traffic through? And they know, right? Amazon knows where the traffic of a business is routed through. Is it a server in the US? Is it a server in Europe, Asia, South America? They know. And what's even more interesting is they are able to make changes to this routing. So they can say, okay, we don't want to have any connection to the United States at all, other than this person using my service. Can you please route our traffic, main traffic, through a server on another country, please? And they can do that. It's not easy. It's not an easy undertaking, but it's possible. I've seen it. So next example, please. Oh no, I have a breakout session now. Sorry. So maybe coming back for a few minutes to this public law. After this 2018 Wayfair decision, of course, a lot of states were thinking about, okay, so what can we do? This is not working for sales tax anymore, but it still exists for income tax. For income tax, this law would still protect in states. And the first state that came up with a solution from their side is the state of California. And they issued a technical advice memorandum in February 2022, which followed a multi-tax commission issuance in the US on the same topic. Multi-state tax commission is something in the US where it's non-governmental. It's something where it's funded by states, and the multi-state tax commission is trying to align procedures, processes for income tax, sales tax on a state level to make it a little bit more difficult to navigate this jungle. And one thing they did is in 2021, in August, they issued a memorandum where they said, okay, we live in the world of e-commerce for quite some time now. And this public law is more or less focused on physical presence. And that's not what the reality is anymore, right? The reality is businesses operate in the web, so it's not necessarily physical anymore for a lot of businesses. Of course, there are businesses that still require physical presence, but a lot of businesses operate in the web. And so what are we going to do about it? So they issued a memorandum where they said, yeah, we make some suggestions. So this could be also create nexus, not just physical presence, but other activities too. And California, sorry. California was the first state who issued something. And on the next slide, you see that there are some activities that are protected under this public law. But there are other activities where they say, where California would say, no, no. We say this is something where you are doing business in our state. And I have some examples here, right? And the second one is especially one I would like to point out. So if a business is placing on California customers' computers or other electronic devices cookies, something like that, that California could say this creates nexus. Right? Or if you offer post-sale assistance with chats or email with a client, California might say, yeah, you're doing business here. I don't care where you sit, right? But you communicate with my client to generate revenue. That creates nexus here. And that's just one example, one state where they say, okay, we need more tax revenue. We want to bring in more states. How can we do that? This is not law, right? Technical advice memorandum is for California, is for if they do a tax audit examination for an officer would be something they can take with them to taxpayer and say, okay, here, this is our opinion now, right? This is what you're doing, and we consider you having nexus, and you have to register here. And now you might ask, okay, but I'm not registered yet. How do they know? How do they know that I do something like this? They would know through your customers, right? The customers might get an audit. California might look at invoices, might see invoices from businesses outside of the US, and then they start investigating. And the next step from California, what they typically do is they send a questionnaire, Nexus questionnaire with questions. And questions related to doing business online with your customers are included on that questionnaire. So you would have to complete it, send it back, and then they would decide. And then you can go against this, of course, because this is not law yet, but they set up everything to just to have it implemented in their procedures. So next slide would also show some unprotected activities. And that's the second bullet here is regularly providing post-sale assistance to California. I mentioned that already, to California customers through an electronic chat, email, and so forth. Yeah, there are some other examples, but I think in the interest of time, we move on. Example 3. So this is a question we get quite often, especially startup businesses. So foreign entity has a virtual office in a state. So virtual office meaning almost every country has a chamber of commerce in the US, which helps businesses outside of the US to get started in the US. And one of the services typically is that they have that they offer a virtual office, meaning the address, phone number, fax number. They receive the mail and forward it, right? But the foreign business itself would not have anybody in the US other than the virtual office. Question we always get is, so virtual office, does that create nexus, right? Some other service could be like custody of original necessary branch documentation or something like that. So question is, so that varies by state, right? So some states where I can give you an answer right now, for example, New York, if you just have an address in New York, we do not consider that as having nexus in New York. So we just say, this is just a mail address, you're just getting mail there, nothing. Florida, we treat it generally same way. So virtual office should not create anything. There's always, of course, a minimal risk for this, but generally we say it should not create nexus. You can start with a virtual office. At some point you want to move on, right? But for now, you might not have to do something. So next example, please, which is quite interesting one also especially for startup companies. So you have a foreign entity that's providing services to a US customer, and let's say 10% of the work will be performed by a US subsidiary. So what's important here? What might be the issues here? Let's say the US subsidiary there's already a company, there are already a few people working there. So for the US subsidiary, not a problem. For the foreign entity problem, maybe, right? It depends how you set this up. Because the risk here is that activities of a US subsidiary will also be seen as an activity of the foreign entity in the United States. The technical term for this would be affiliate nexus. So the foreign entity might not be itself in the US, but it has someone meaning US subsidiary, operating in the US. And the question is, and that's what the tax authorities would look into, is it just on behalf of the US entity, so that we say, oh yeah, okay, so you're using a US subsidiary, but it's essentially the US entity is doing something here. The foreign entity, sorry, is doing something here. And it's not 10% of any revenue that's generated that's allocated to US. No, it's 100, right? Because you're just using this US subsidiary as a fund, and the back, it's a foreign entity that's operating here. So important here would be that, again, this is set up properly in a proper way, meaning there need to be agreements between foreign entity, US subsidiary, who exactly is doing what, who is exactly getting compensated for what. The foreign entity might buy the services from the US subsidiary. There's transfer pricing considerations to be accounted for, which we talk about later. But the most important thing here, and I leave it at that, is really how do you set this up to strictly separate what the foreign business is doing and what the US business is doing, right? To avoid any commingling. Let it be through employees from the foreign entity that are working in the US on this project, being on the US subsidiaries offices, or any other thing like that, which would mix up, right, the two entities and would make it difficult to see, so who is doing what here, right? So next example, and that's the last one, a flash title scenario. I have that quite often too. So what exactly does that mean, flash title? So that has something to do with importer on record. So let's say you have a US subsidiary buying something from the foreign parent headquarter, shipped to the US, and the importer, let's say the importer on record, would be the foreign entity, right? So they would deal with the customs and everything. And then the question would be, so, and if it goes to a customer, the question would be, so where does the sale take place, right? Does the sale take place in the US, even if it's a flash title scenario, because flash title would include terms that say, upon customs clearance, title transfers to the customer in the US. Would that already create a sale in the United States? That's a big question here. And I make this brief. It's a state-by-state analysis again. Some states say, yes, it does. Some states say, no, it doesn't. Okay. I don't see any questions in this chat or something like that. So I think we can move on to transfer pricing. So basics of transfer pricing. So what's the issue? That's on the next slide. So the moment we have something going on cross-border between US business, non-US business, any transaction, I have some examples on this slide, we enter the space of transfer pricing where we would have to see if it's tangible products, if it's sharing of employees. So what's the compensation? Is it a proper compensation? If it's a deduction, if it's an expense on the income statement in the US, is it a proper expense? Is it not too much? Is it not too little? Same on the other side. Eve mentioned that before. You always have to look at both sides, right? If a foreign business is providing services to a US business, are they compensated in the right way? Not too much, not too little, so that every tax jurisdiction, whether it be Europe, Asia, South America, US, that they get their share. Right? And everybody knows there's huge discussions on the OECD level about this, but let's stick here with maybe with some basic concepts from a US perspective. So examples, and I said, any transaction, right? Sale, inventory, cost sharing, rents, royalties, financing, interest payments, very important. Premiums for insurance, reinsurance, global mobility, employee relocations. And that's for startup businesses. When we talk about businesses who want to come to the United States, most of it is interest payments in the beginning because there is some funding that needs to be done. That's something we need to talk about. And services, providing services. There might be a shared service center somewhere that needs to be paid by US entity. So that's basically what we see in the beginning of the life cycle of an entity when they start in the United States. So what's the solution for that? That brings us to the next slide. So solution starts with transfer pricing planning, and planning starts always with the thought that, okay, you realize that there is an issue, right? Because once you've started, sometimes it's maybe too late. You want to know at the very beginning. So what do you have to do? Is there anything specific that you would have to do right from the start? And if so, what exactly it is? So I mentioned that just a minute ago. Most importantly, there needs to be documentation between the related parties, between US and any foreign person. How prices between related parties for services or products or whatever transaction it is, loan agreement, how are they determined, right? What is it and how are they determined? What some businesses do right from the start is they do a benchmarking study, which is one of the products our firm can help with. On the other end, there would be a transfer pricing documentation, next point. So there's basically these two products, benchmarking study, transfer pricing documentation. And with a benchmarking study, a business would get an idea what the expected, let's say, if we key performance indicator, if that's chosen, let's say operating margin, gross profit, whatever, what the expected key performance indicator would be from a US perspective, right? And then management can take that benchmarking study to plan, to see, okay, where do we stay with our planning, with our business plan for this year, for the next 2-3 years? Would that make sense? Right? Something that can be done, right? Need to be discussed. If the business is growing at some point, and from a US perspective, transfer pricing documentation is highly recommended. And from a US perspective, it's not like in many other countries. You don't have to submit a transfer pricing documentation with a tax return. That's very important. And that's a reason why a lot of businesses say, okay, we wait. We don't do it now, we wait a little bit. In other countries, we have it. We even have it for the US, but for US specific purposes, we don't have it and we wait. That's fine. If you don't know, OECD standards are used by all countries, almost I would say all countries around the world, except for the US. So US has different documentation requirements. So if you already have something, master file, local file for one country, so master file in one country and local files for different countries, even if it's for the US, you can go with that for now. Again, at some point it might be required. We might highly recommend that you do a US documentation. And the requirements are different, US, OECD. A lot can be used from a US OECD transfer pricing study. And if we have a case like this, we typically piggyback on the OECD study. We review it, we analyze it, and we can adjust it so that it also matches US documentation requirements. It can be done right from the start, but if you have something, master file, local file, just OECD, we can look at it and we can make it US compliant. And the next bullet points, they show you, there's a lot you might recognize if you already have some familiar or some experience with transfer pricing studies, always according to OECD. For example, overview of taxpayers' business, right, including economic legal factors that affect pricing. You might already have that, right? Description of organizational structure, right? Also, it's a given. It's the same. Right? Description of the method selected. The methods are almost 100% the same, US, OECD. Where it gets, and that's on the next slide, where it gets a little bit more complicated is the requirements in terms of the methods that are used, description of the comparables that are used, explanation of economic analysis projections relied on, and so forth to develop the method. That's a little bit, it's US specific, and the IRS has really certain expectations in terms of how exactly they want to have it. There's a FAQ website from the IRS where they talk about this. I'm not going into details here, but that's something where some work might need to be done to make this satisfactory for the IRS. Although I always have to say, it's not a guarantee. Transfer pricing study can be rejected by the IRS. There was a court case not too long ago where the taxpayer had an audit from the IRS. IRS did not agree. IRS came up with their own transfer pricing analysis. Taxpayer did not agree. They went to court. So it ended up with a tax court in the United States. So what did the tax court do? Rejected both. So rejected IRS, rejected taxpayer, and came up with their own. Just as an example of what can happen. But the transfer pricing documentation in the US, the main purpose is really, if there are adjustments, to protect a business against penalties. Okay, next slide, please. And that's the last one. So again, just brief. US transfer pricing documentation requirements. It's not required, but minimize or eliminate penalties. So the penalties, they might be avoided through this transfer pricing documentation. And one important thing to keep in mind, I said you don't need to submit a the transfer pricing documentation with a tax return, but the moment you submit it, you need to have it. So it needs to be in existence, so to speak, right? So let's say you submit your tax return today, and today you should have a completed transfer pricing documentation. So how do you prove that it was in existence? Yeah, emails, email exchange with your advisors, saying, oh, this is the final transfer pricing. And the IRS can request that documentation. They can really ask for these emails. I've seen that they ask you, so how can you prove that it was there? And then, yeah, here are the emails. And typically that's sufficient. But that's just something you need to keep in, everybody needs to keep in mind. Which brings me to the last polling question, number 5. And that's something I skipped. You might not know this. I have to say a few sentences about this. Is transfer pricing just an issue on the federal level in the US? Please select one. While we're waiting that this is closed, yeah, I skipped that there was one on the previous slides. So I only talked about transfer pricing on a federal level and US, foreign country. You also have this transfer pricing issue in the United States because what we heard from Eve earlier, we have 51 jurisdictions in the US. We have federal and we have the 50 states. Once a business is growing and has operations in multiple states, they might take a look at the tax rates, right, in different states. And what we've heard from Eve is there's significant differences. So a business might start thinking about So how can we minimize our tax burden in a state? Can we not just shift, and can we not just charge management fees between states? And you can do that. You can reflect it on the state tax return. You can shift profit. And the thing is just that you also have to consider transfer pricing here. And almost all states follow federal transfer pricing rules. They follow the tax law, the federal tax law, or they have their own tax law, which is close to the federal tax law. So it's not just an issue between US and foreign countries. It's also an issue within the United States when a business is active in more than one state and has transactions between states. So, and that's it from my side. I don't see any questions in the chat. I give it back to, I don't see any. Maybe, I don't know, Leo, if you see anything, but we have,
I see one.
we have 7 minutes left. I give it back to Leo.
Can you hear me, Ralph?
Yes, I can hear you. Yes.
Yeah. In example 4, this one may be for you. In example 4, if the US sub is set up as a blocker entity, wouldn't that overcome affiliate nexus? That's an excellent question. And we wrestle with it all the time. I'll let you answer that, Ralph.
Yeah, it's a good question. Not necessarily. I know, and I see someone is already familiar with the term blocker. It's not necessarily the case. It really depends how do you operate here in the United States. And with the one thing when you read up some regulations on that or some articles, it might even be the name. Let's say you have the name ABC Inc. in another country, and you have the same name ABC Inc. in the US. So what's the difference here, right? So the tax authorities might come and say, that's ABC Inc., that's affiliate nexus. You're just using this to avoid being active with ABC Inc., with foreign ABC Inc. in the United States. So the answer to the question is not necessarily. There's a risk. Yeah. Do we have another question, Leo? Oh, Leo is frozen. Eve, are you frozen? No, you're not. And you can hear me.
I can, yes.
Yeah, I think Leo is. Let me check that. Just wondering, why do I not see this? So I'm sorry about that, but it looks like we lost Leo because his video is frozen and he's not talking. Now he left. Maybe he's rejoining. We still have 5 minutes left.
We do have
So you can
5
still.
minutes. We have plenty of questions. I can see questions on my end if you want to continue.
Oh, really?
Questions.
Oh, yeah.
Yep,
if you.
absolutely.
Yeah.
So one of the questions that came in, and feel free to answer it or punt it to, we can answer post-event, but what about Article 7 in U.S. treaty model? Would that attribute the business activity to the U.S.?
Can you repeat that, please?
Sure. What about Article 7 in
broken.
the U.S. treaty model? Would that attribute the business activity to the United States?
The treaty, the model treaty. No, because I mean, it depends on the treaty between the US and the foreign country. The model treaty is really, it's just a model treaty. So I don't know if I address the question correct. I mean, in the way the participant is expecting it, but if you have a country, that's the way I understand it. So if you have a country where the US does not have a tax treaty with, and there are plenty, right? It's Colombia, Hong Kong, one very prominent example. There's no tax treaty, so you would not go and use a model tax treaty to use that in a certain scenario. You wouldn't. So
Yeah, I think we're talking here about also, you know, the contracting states not taxing the business profits arising from that state unless they're attributable to a permanent establishment. So I'm not sure about how to answer that properly, but if there is a permanent establishment and the income tax treaty confirms that, then yes, it will be taxable in the contracting state. Of course, there will be some exceptions to that depending on the activity of that company in the United States. And also, there's limitations on any benefits that also should be looked at when we look into the income tax treaties.
Yeah.
So I'm not sure,
Yeah.
Harleen, if that's the proper answer to the question.
The thing is that we would, if there's no treaty and we don't use the model treaty, it would go back to US tax rules. It would go, then it would be a question of effectively connected income. That's a technical term. Then it would need to be examined if, according to these rules, which are the federal US tax rules, if there's effectively connected income. Right? And that it would be done that way, but not with a model tax.
Yeah. I don't know if
Leo,
we have
you're back.
time for questions. Leo, welcome back, but your audio is still a
audio
bit,
is still not working. Do
it's
you have
not
another
working.
question for us? Because we have 2 minutes left, and then
Absolutely. We do have one more. We have plenty of questions, but one question, it's relating to your example one, actually. Do subcontract agents of a foreign parent company attending the United States count towards the 10 days for creating nexus in the state?
potentially, yes, yeah, yes. Because the question, if you're using independent contractors, that's also a separate analysis, unfortunately, because you might say it's an independent contractor. From a US perspective, the first step is it really an independent contractor? Does the independent contractor agreement, does that comply with US rules, or is it not rather an employee? You're just using this person. And then it's also really the question of what exactly is this person doing? If it's going to, what kind of authorities does it have? Is it going to a trade? If it's going to a trade show, right? Is it just allowed? Is that person just allowed to speak with people, or can that person already take orders? How independent is that person if it's an independent contractor? Right. There's a lot of moving parts here, but the answer cannot be no. Right. The answer can only be, we have to look at that. We would have to look at that. I know it's not a satisfactory answer, but it's unfortunately like that. It's 50 states and different rules. So.
And it's also a legal advice, right? So Ralph, it's a legal type of advice if we're trying to differentiate an outside service provider from an employee.
That's right. I mean, that's a good point. We can look at it from a tax perspective. So would it create nexus? But the analysis I just mentioned, employee versus independent contractor, we might need lawyers to look at contracts and to analyze them, because accounting firms in the US typically are not allowed to provide, or not licensed to provide legal services, legal advice. So.
All right. Well, thanks, everyone.
Yeah, okay.
I think that's all the time we have for today's webinar. So we'll go ahead and conclude. So thank you to our speakers, and thank you everyone for attending. Please remember to complete the short survey that's prompted at the close of this webinar. And just a reminder, a recording of today's webinar and a copy of our PowerPoint slides will be made available to all attendees via email within the next few hours. Additionally, CPE certificates will be issued within 8 to 10 days via email. Thank you again, everyone, and have a great rest of your day.
Thank you, everybody.